Hey there, stock enthusiasts! Today we're diving into the exciting world of call options. Options can seem complicated, but don't worry, I'm here to break them down for you. In simple terms, a call option is like a coupon that gives you the right, but not the obligation, to buy a stock at a specific price called the strike price within a certain time frame. Think of it like putting a down payment on the chance to buy a stock later at today's price. If the stock price goes up, you can use your option to buy it at the lower price and make a profit. But remember, just like any coupon, a call option has an expiration date. If you don't use it before then, it expires worthless. Now let's look at how call options actually work. You buy a call option from an option seller. The price you pay for the option is called the premium. This premium is like an insurance premium you pay to have the right to buy the stock later. Let's say you're interested in a stock called Tech Company, currently trading at $50 per share. You believe the stock price will go up soon. You buy a call option with a strike price of $55 expiring in 1 month. You pay a premium of $5 per share for this option. If the stock price of Tech Company goes up to $60 before the option expires, you can exercise your option and buy the stock at the strike price of $55. You can then sell it at the market price of $60, making a profit of $5 per share minus the premium you paid. However, if the stock price stays below the strike price, you will likely not exercise the option and it will expire worthless. You will lose the premium you paid. Imagine you're a coffee lover, and your favorite coffee chain, Coffee Bean, is currently trading at $100 per share. You're optimistic about their new coffee blend and believe the stock price will rise. You decide to buy a call option for Coffee Bean with a strike price of $110, expiring in 3 months. You pay a premium of $10 per share for this option. Fast forward 3 months, and the new coffee blend is a hit. Coffee Bean stock is soaring, now trading at $120 per share. You decide to exercise your option, buying Coffee Bean shares at your strike price of $110. You then sell those shares at the current market price of $120, making a profit of $10 per share. However, remember to subtract the $10 premium you initially paid for the option. This example shows how call options can amplify your profits when you predict a stock's price movement correctly. Call options can be powerful tools for investors, offering the potential for significant returns. They provide leverage, meaning you can control a larger amount of stock with a smaller investment compared to buying the stock outright. However, it's crucial to remember that options trading involves risks. The biggest risk is losing your entire premium if the option expires worthless. Before diving into options trading, do your homework. Understand how options work, assess your risk tolerance, and consider consulting with a financial advisor. Remember, options trading is not suitable for everyone, and it's essential to trade responsibly.